Shares in JPMorgan under pressure. The bank kicking off U.S. earnings season with results that were higher than forecast, but a warning from the CEO, Jamie Dimon, that trouble could lie ahead. He's still worried about growing geopolitical tensions and persistent inflation seems to be cooling investors' ardor. We're joined by Gerard Cassidy, Managing Director and Co-Head of Financials Research at RBC. Thanks very much indeed for joining us. We're seeing a sell-off in JPMorgan, a darling among investors. Why is that today?
Andrew, I think it comes down to really profit taking. When you take a look at this stock, it's been a very successful stock for all of 2023. Year to date, it was one of the leading bank stocks as well. Them and Citigroup, Wells Fargo, another stock that's done well this year. And I think it's that simple, that people have done well with it. And with the expectations of rate increases being fewer this year, there was a hope by some of the, the traders that they would give a better guide on their net interest income this year, because in January, the net interest income guidance of 90 billion was below the 97 annualized number they posted in the fourth quarter, and they pointed to the 6 Fed fund rate cuts that they were assuming as a factor for bringing that net interest income down. Now that the forward curve is only pricing in 2 to 3, everyone thought they would give an updated guidance number, a higher number, and they didn't get it. So I think that's the main reason the stock is off, particularly amongst the trading community.
Jamie Dimon, one of the most widely watched figures on Wall Street, has been pessimistic for quite a while now about the global outlook for financial markets. What do you think?
No, he is certainly a cautious individual. He's always looking over his shoulder to make sure that there's not something trying to sneak up and surprise the company. And he certainly, wrote that in his letter, his shareholder letter that was posted earlier this week, that, there's real concerns, not just with the geopolitical risks, but the outlook for interest rates. Nobody knows for sure, where interest rates will certainly go over the next 12 to 24 months. But there are some trends out there that make them very nervous. One of the biggest trends is this U.S. government debt, and the deficit spending and the financing of that debt is quite large. And that is certainly one of his concerns, my concerns as well. And so that's part of the reason I think he has such cautious outlook about what's going on in the financial markets. And then, of course, the uncertainty with the geopolitical risks of the Middle East, as well as the Ukraine-Russian conflict.
You have an outperform on JPMorgan. Wells Fargo, though, you have a sector perform. Why are you more cautious on that name?
Yes, the primary reason is that Wells still has the asset cap that restricts its ability to grow its balance sheet, coming from a 2018 cease and desist order from the Federal Reserve. We expect it to be lifted at some point, possibly in 2025, but that's what we're trying to figure out. When could that cap be lifted, and then the stock really could have some legs on it. But in the meantime, the company has done a very good job of managing its balance sheet, growing its capital markets businesses, and then returning excess capital to shareholders through share repurchases. Because without being able to grow the balance sheet, the capital is accumulating on it, and they're able to give it back through share repurchases.
Citigroup, it was a beat there, $1.82. The street and you were only at about $1.34. You do have an outperform on Citi. Why do you like this name?
This is a self-help story. When you look at it closely, Andrew, what you'll find is that Citigroup has a restructuring that's almost completed. They've been divesting of unprofitable or less profitable non-U.S. operations. That is almost completed. And the big one that's left is spinning off their consumer banking business in Mexico. Banamex is the bank down there. That should take place next year when they IPO that business. And so that self-help story is really I think finally taking hold. The expenses are coming in line. The real question for investors longer term is, can Citi grow the revenues the way they believe they can grow them? But in the meantime, you've got the expense savings. And then more importantly, they too have quite a bit of excess capital. And when the final rules come on capital under the Basel III endgame, Citi will probably be very well positioned to buy back their stock, which of course trades at a very meaningful discount to book value and tangible book value. So that would be very accretive to tangible book value per share and very beneficial to shareholders. So it's a self-help story with, on top of that, a big capital return story coming over the next couple of years.
Broadly, does it look like these troubles of the regional banks are behind them? And we have had this move up in bond yields, and of course that reduces the nominal value of long-term bonds in their portfolios. Could we get into fresh problems?
It's a very good question because certainly the unrealized bond losses are higher today than they were at the end of the year as the 10-year government bond yield has gone up. We don't see it as being as much of a concern for investors today as it was a year ago. You might recall when those banks failed last March, the primary reason Silicon Valley failed was its inability to raise capital after they took unrealized bond losses through their income statement or realized them. And there was an ensuing panic that went on, and they had a deposit run. And of course, the company failed. Today, people realize that banks are very well funded. There's no need to go out and have to sell bonds at a loss. You just have to ride with them until they pay off. And that's the other part of it, Andrew, is that we're a year now into this environment, the higher rate environment, which means that, a part of the bond portfolios have already paid off and the durations have shortened. So I think as the time goes by, even with higher rates, it becomes less of an issue for the banks, the regional banks, because the portfolios will have paid down and the unrealized losses will have declined. But it is something that investors will keep an eye on. And certainly with the 10-year now, in the 4.5% to 5% range, that is an area that will lead to higher unrealized losses. But if the 10-year, stays in this range, it's very manageable. But if you're in the Jamie Dimon camp and you could see long end yields of the curve, exceed 6% or even head to 8%, I think he has commented in his shareholder letter, that would be problematic for the banks, no doubt about it. But right now, even though the yields are higher, unrealized bond losses will go higher. We don't see them as being a big threat to the regional banks at this time.